Hi, everyone. It's Elizabeth again with Hustle Fund. And a couple of days ago, I received another cold email from someone named Jamie who had some great questions about fundraising. And specifically, they were around things to incorporate in your deck and also whether you should include financials or whatnot. And so let me actually just share with you the questions and then we'll kind of dig right in. All right, so let's take a look at the questions. And here they are. 3 questions. You mentioned that you are open to honest and direct questions of any kind, so here we go. When reviewing pitch decks, do you believe it has to be precisely a 20-slide deck, or do you think that's ridiculous? Do you like to see projected financials at pre-revenue? What is your opinion on exit possibilities? Some investors say they like them, some don't. Curious for your thoughts here. So those are the questions. Well, Jamie, I'll answer them with my two cents on this, but as we all know, investors have differing opinions, as you alluded to in the last question. So here we go. So first off, format. So I actually think that there are 2 decks that are important. One I call an email deck, and then the other one is your pitch deck. Your email deck should basically be an abbreviated version of your deck. So it could be 5 slides, something as simple as what is the problem, what is the solution that you're going after, something about the market, something about your traction or notable results, like if you have a pilot, or if you are signing a contract, or if you have some users, anything notable there, or even just like a case study. And then the last one about your team. Doesn't have to be that way, but I would keep it to roughly 5 slides for an email deck. And this is a deck that you simply can email to various people to use as a teaser to get a meeting. The purpose is not to try to convince somebody to invest, but the purpose is to try to get a meeting. And then from there, you can actually pitch the full pitch with an actual deck. And in an actual pitch deck, I actually think that 10 slides is more than enough. It doesn't have to be exactly 10. I don't think anyone is dogmatic about it. But roughly speaking, the 5 slides that I mentioned, plus an elaboration on other things, like what is the business model, or what are some of the unit economics, if that's an important thing, like if you're doing a marketplace or you're an e-commerce company, the COGS that you have or the revenue split in the middle that you're making is going to be really an important factor. So a few extra slides to kind of elaborate on how this works as a business, and there you go, that's your 10. I think it is great to actually have appendix slides and have a slide on each anticipated question. And for every company, that's going to be different. Like if you keep on hearing a question about some competitor because you're in a very crowded space, you may want to actually have an elaboration on that. Like you may want to have a competition slide amongst your 10, but then have a lot greater analysis around particular things in your appendix slides. So keep it close to 10 for your main pitch deck. I don't think there's any hard and fast rule about any number of slides, whether it's 10 or 20, and then have a number of things in appendix. Now, what's the difference between having slides in appendix as opposed to in your regular deck? Well, in appendix, it means that you won't get to them unless somebody asks. And that's fine. A lot of investors will want to ask you more questions on certain things and don't care about other things. And you don't want to introduce new potential risk areas. So I would just let the investor make sure to ask all of his or her questions about concerns, and then you have a ready answer in the appendix. So broadly cover the high level in 5 to 10 slides, closer to 5 if you're sending out an email deck, closer to 10 if you're doing an all pitch deck, and then have appendix slides. I would not include the appendix slides in your email deck because you want to be able to answer all of these questions, all these hairy questions in person, but that's just kind of generally how I think about things. Secondly, let's talk a bit about financials. So financials, I think this is just me as an investor. I don't care about financials. I'm just going to assume that they're going to be wildly off, for better or for worse. And it doesn't matter to me. I invest pre-revenue. So I think you'll get most of your learnings from actually doing than by predicting. That being said, and I'm going to go ahead here to my whiteboard, but I do think that financials come in a few flavors. So let's kind of talk through that a bit. There's the traditional VC request for 5-year projections And there are some VCs, especially outside of Silicon Valley, who will still ask you for that. Personally, I have never seen anybody do this exercise of building out 5-year projections and getting funded, because it's like a Goldilocks and the Three Bears problem, where you are either not ambitious enough, or you are too out there and unrealistic. I have just never seen anybody win at that game. And I have armchair quarterbacked a lot of people's raises. So here's what I would do. If somebody is asking you for 5-year projections, I would ask to clarify, like, I'm happy to pull together something, but as we all know, 5-year projections are going to be wildly off. And I would love to understand, like, where your specific concern is. And that is what I would use to respond to somebody who asks you for 5-year projections. I do think there are investors, even seed stage investors, who will ask you for 1-year projections. This, I think, is actually fair game. So I would say 5-year projections, push back. 1-year projections, I would say that's fair game. And why is that fair game? Well, you still may be wildly off, but an investor generally wants to know what you're going to do with the money. And hopefully you're raising enough to cover at least a year. So what is it that you plan to do with the money? And those projections, in large part, inform that. And what is it really informing? Well, I would call it the levers of the business. So what is it that really affects what? So for example, every dollar you put into advertising, does that actually yield $3? And if so, that's actually a really strong lever. In fact, that is probably a much stronger lever to put $1 into that than it is to put into something else. Like putting $1 into something else may not move the needle for your business either as much or at all. So an investor really wants to understand how you think and wants to understand, like, where the areas are that have the biggest impact. And then on the flip side, costs. I think for a lot of people, the most expensive thing is going to be people costs. Well, is that actually a cost lever in the business? Or is it something else? I think in some businesses where, let's say, you can book revenue up front, but you actually don't get paid for many months because you're invoicing, that's an interesting thing for investors to look at. Because even if you are making money, that's actually a terrible cash cycle, and a lot of investors may not like that. So I would really try to understand what is it that is going on in this business in terms of cash allocated to what and how that has an impact. And that's what investors who are asking this question are looking for. I think lastly, even if you are at seed, you may have some idea of what kind of milestones you can hit. And if you don't, I would, if you have any idea about your customer acquisition, even if it's just preliminary data, like you put in 50 cents into ads, and then that yields out, $1 in a month, like I would use that to try to project out, okay, well, what does that end up leading to revenue-wise in 12 months? Like, and if you change how much you pour into ads, what kind of milestones do we think you can hit? So, I mean, part of it is like, where is there the biggest impact? But the other part of it is, okay, like if that holds out to be true, what sort of milestones do we believe this company can hit? And can they get to Series A milestones? In SaaS these days, I would say Series A milestones might be around 2 million run rate. Can you get there in a year if you rinse and repeat your customer acquisition process that has been working to date? Now, it may stop working because you have so little data on it, and it just may saturate out or whatever it is, or the market could change. But just hypothetically, what does that kind of look like? So that, I think, sort of answers your question on number 2. Like, I would do 1-year projections. I would push back on 5-year projections. If you're pre-seed or pre-revenue, have you done any tests? And if you haven't, actually, I would encourage you to do some tests. Like, there are plenty of free ad coupons floating around on the internet these days. Snatch one of those and try it out. Because these are the kinds of things that investors want you to have thought about, even if you are not actually generating revenue. The last question here is exit possibilities. I actually think that, I'm camp, no exit possibilities, which I think Hunter Walk is also in, which is, I think companies, when I'm looking at companies, I'm looking to be an investor for the long haul. So I'm probably going to be in this investment for 7 years or 10 years or maybe even longer if everything goes well. In which case, I don't even know who is around to buy the company in 7 to 10 years. Big companies today who are very acquisitive, it doesn't mean that they're going to continue paying big bucks for big companies in 10 years. And there may very well be companies who are not very acquisitive today who may be in 10 years. Like in the US market, for example, I'll bet nobody puts Stripe down as an acquirer these days. But in 10 years, I'll bet they will probably be doing tons of acquisitions. So I think, things like that. I think, on the flip side, people today might be putting down Facebook as an acquirer. In 10 years, like who knows? Will Facebook be around? Will people be using Facebook? Will they, run into trouble with the SEC? Like, who knows? And so this is where I think that it's just so hard to predict what the exit possibilities could be. It could also be that there's, the long-term stock exchange as a more viable opportunity for going public in a better way than traditionally has happened. I'll bet that will change things in the next 5 to 10 years. So that's why I don't care about it, but I know that other investors do. So I don't think that there's a hard and fast rule here. But I would say that regardless of what you put down for this slide, whether you include a slide about exit possibilities or not, I'd be willing to guess that if someone passes on you, it's not because of that slide. If someone passes on you, it's because they were not bought into the opportunity. And so that would be my 2 cents on point number 3. It is not very important, frankly speaking, and I wouldn't think or care too much about it, but that's just me. All right. Have a good day.